Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focused Compounding Podcast, sitting alongside Geoff Gannon. Geoff, how's it going today?
It is going great, Andrew. How is it going with you?
It's going great. We hope it's going great for everybody else as well. Hey, if you are interested in learning more about our new fund that we are launching January 1st, 2020, or just our money management services in general, go to Invest With Us, the Invest With Us page on our focuscompounding.com. You'll see the link up top. Click Invest With Us. You will get all the information you would want to know about us, or reach out at invest@focusedcompounding.com. If you're watching us on YouTube, hit that subscribe button, thumbs this video up. We obviously have been pumping out a ton of videos. I think it's a fun form of content for people if they like to see us actually talk about it. And then, of course, if you are watching on or listening on the podcast app or Spotify, leave us a rating review. That helps spread the word on the podcast. If you like the work we're doing and want to support Mr. Geoff and myself, that is the way to do it. So today we are going to be doing our 5 minutes on 5 different stocks. This is a very popular segment and one that we are going to probably do weekly now. I think our new schedule going forward for the podcast is Monday, Wednesday, and Friday. So maybe we'll do this every Wednesday. And if individuals, want us to go over a stock, you can send it to me at Focus Compound on Twitter, and maybe we'll pull it from there. We don't want to upset anybody if we don't like your stock. But today, so the first one is going to be Miller Industries, ticker MLR. We are using quickfs.net, which is just gives you a snapshot of the company's financials. And they have a market cap of $413 million. Currently trading about 11 times earnings. EV to sales is 0.5. Again, we want to see the EBIT margins be in the area of 5% for it to be cheap for us, or kind of interesting. Do you want to explain that? Because we get a lot of questions why we do that.
About what the EBIT margin needs to be versus sales?
Yeah, why we look at that.
Okay, so just on a normalized basis, we would like to, we want to see if it's sort of a normal price for a stock, and historically a normal price for a stock was about 10 times pre-tax earnings. Now it would be higher than that. It could be closer to 12 times because taxes are lower, corporate taxes in the U.S. are lower. So, but the example would be, let's say you were trading at, the easiest way to do this is 1 time sales. Then you would want to see a 10% EBIT margin, or you flip it around. If you have a 10% EBIT margin, you want 1 time sales. Now, when we say that, what we really mean is either they can achieve it in the future, which is all we really care about. But since we don't know the company yet, we're using the past record to base on the future. What we generally don't want to see is it's trading at a level that means that it's greater than 10 times pre-tax earnings based on any margins that they've ever had in the past. Yeah. So basically, they would need to have higher margins in the future than they've ever had in the past. With a stock we're just getting to know, that's not possible. I mean, we can't bet on that. We would have to know that the future is going to be a lot brighter than the past. And so usually we like to bet that the future will be a lot like the past, at least when we do these 5-minute things. So,
absolutely. Yeah. EV to free cash flow, 46 times. So figure about 2 to 3% free cash flow yield. 10-year CAGR on revenue, 10%, going from $238 million in 2009 to $712 million in 2018. EPS has grown by 25% per year over a 10-year period compounded. What else? We got for median returns, return on equity, 10-year median returns 9.2, return on invested capital 12.1. And it looks like it's been rising in the past couple of years. We got 16% last year, 12% the year before, but that's all been going up.
Yeah. Revenue.
So do you know what this company does?
Miller Industries, I think, does wreckers. I think I said, let's see. So I think that they make the bodies basically for trucks that are used to take away cars that have literally had wrecks and things like that, and also just to move cars that way. But like small time operators would buy it from them, I think.
So we got a beta of 0.96. We could read the business description. They engage in the manufacturing and sale of towing and recovery equipment.
That
so exactly,
like wreckers, Oh, it says wreckers.
Yeah, it offers wreckers that are used to recover and tow disabled vehicles and other equipment.
If I remember right, I think they're by far the biggest. Could be wrong about that, but I think they're by far the biggest.
At $406 million market cap.
Yeah, but the margins are pretty
It's
low and
700
stuff.
million
So the sales are 700 million in sales, which I mean, presumably these things last a long time. So if you think about that, that sounds like they could have a big market share. So problems that I see right away: price seems fine, and predictability seems okay. It looks like something you wouldn't lose a lot of money in. However, in terms of the upside, I see some issues, which are that the historical return on capital over the last 10 years looks mediocre. Okay, but not great. So if you were buying it at less than book value, it would be attractive, but we can see the price to book, you're paying a premium. I don't know that you want to pay a premium for something that has like a 12% or so return on capital historically. And on top of that, it has cyclicality. You want to be extra careful with any company that has cyclicality because of the way compounding works and stuff. A less cyclical return on equity, I'd be more comfortable. Like a 15% return on equity that you have every single year, I'd be much more comfortable with than a 15% average in a very cyclical kind of thing. So on an asset basis, that's a problem there. On a sales basis, it looks okay in terms of EBIT. You have a 5% historical EBIT margin, and then you have an EV to sales of 0.5. That looks fine. The EV to EBITDA looks like 8 times. All that stuff looks fine. But as you said, they're not converting a lot of it to actual free cash flow. And if they're a very cyclical company, a problem could be that they have difficulty converting from reported earnings to free cash flow. So on a reported earnings basis, I like it. I'm fine with it. I'm just worried that they're not actually converting it into free cash flow. The price looks okay, versus reported earnings, so it's one that you could definitely add to a watch list or something. But to be honest, it's the kind of thing I think other value investors would like more than us, because we put a premium on kind of things like return on capital and free cash flow. And to me, it looks like over a full cycle, return on capital may not be that great, and free cash flow may not be that great. And so on a reported earnings basis, it'll look good, but we don't care about that. We care about cash.
Got it. Okay, next ticker, MATX, Matson Inc. It's got a $1.6 billion market cap, currently trading 18 times earnings. EBIT sales 1.1, 10-year median margins for EBIT about 6.1. Let's see what it's been a little bit more so recently. Looks like it's in the 6 area. 10-year CAGR on revenue about 1.7% from 2009 to 2018. 2009 they had 1.3 billion in sales, and in 2018 about 2.2 billion. Return on equity 16%. Is the median return on invested capital 7.4, and then EV to free cash flow here is showing a negative 25 times.
So this is a transportation. It's the industry I'm looking at says transportation.
Let's see what they do. It's got a business description. So 1.59 beta. So probably something that we wouldn't be interested in.
Yeah, and that's probably due to
and it's a larger company.
Cyclicality. Yeah.
Provides ocean transportation and logistics services.
Not an area I know a lot about. In terms of the results that I just saw over the 10-year results, it's extremely cyclical, which makes it difficult for us to know what the returns would be. We tend to like very non-cyclical companies. And I think I may have looked at this company once if it was a spinoff or something. If you go down to the bottom of that business description, it says it was founded in 1882 and is headquartered in Hawaii. So, there it is. It was part of, it is Alexander & Baldwin. So I knew Alexander & Baldwin. So I don't know this company in its current form, but I did look at that company 10 years ago or something. Mm-hmm. It's just something, it's very cyclical and something that I don't know well enough. I don't know that we'd ever buy a shipping company or something like that if that's what it does. Mm-hmm. You can look, we're looking at a graph right now of the return on invested capital, and it's all over the place. That makes it difficult to buy unless you're getting at like a really poor point in the cycle or something. Even if we just look on the return on equity, return on invested capital doesn't look that great. Return on equity when it uses some leverage is okay. But this is the kind of thing, I mean, maybe if someone was like talking about it less than price to book of 1 or something, or I knew it was the bottom of the cycle, then we might look at it. I mean, it's not something that we would ever own. But if other people were asking me, should I look at it, I would say like it's the kind of stock that you'd want to look at a really bad point in the cycle for the industry. Yeah.
Got it. Okay, let's see. Next stock, Badger Daylighting, ticker BADFF. It trades over the counter. This is a company that operates or trades in also Canada as well. This is just, I think, the U.S. version of it. Market cap 944 million. Currently trading about 19 times earnings. EV to EBITDA about 9. EV to free cash flow 33 times. Let's see. 10-year CAGR on revenue is pretty good, 14%, going from 128 million in revenue in 2009 to 458 in 2018. Let's see. EV to sales is 2. And we get a 10-year median margins on an EBIT of about 17%. Return on equity, very high, 25% is the median return for the past 10 years. So this looks like a very high returning business. 10-year CAGR on free cash flow, 59%. And everything looks pretty predictable. Pretty much from a snapshot, this looks pretty interesting.
Yeah. So from what I'm seeing here, it looks like it has grown a lot. And it's grown a lot in the last few years, too. It has very good numbers on a reported earnings basis. From this that we're looking at, we don't know about the free cash flow. Now, that could be justifiable. The free cash flow looks very low.
Are you saying, what do you mean?
The free cash flow margin looks incredibly low compared to the EBIT margin. So what I'm looking at here is like an EBIT margin, 17% median EBIT margin, and then a free cash flow margin of 4%. But that's fully justified if you're reinvesting everything in further earnings. So like if your receivables and stuff are going up all the time, or this is a service company, so probably not inventory, but say it was a retailer or something, it would be inventory. But receivables might be going up all the time. You might have to be investing in property, plant, and equipment. That would be totally justifiable if you're investing all of that, and that's why you don't have much free cash flow. There could be other reasons why you don't have much free cash flow. But certainly it looks good on that basis. Without knowing more about the business, it is standing out to me that that's a very low gross profit for something that's calling itself a service company. It's incredibly low.
Assuming this is actually a service company.
Yeah. So, I mean, it says professional, scientific, and what is it? It's an industry group. Let's look it up.
Pulling out the Bloomberg. Badger daylighting. Let's see. Beta of 1.17.
Which is high for us.
Yeah. Provides non-destructive excavating and related services in Canada and the United States. It uses a pressurized water stream to liquefy the soil cover, which is then removed with a vacuum system and deposited into a storage tank.
Conduits, cables.
The company offers daylighting services for visual confirmation of buried lines, directional drilling, test holes, pipeline and utility crossings, subsurface utility engineering test holes.
Yeah, and it does utility. Customers are utility, oil and gas, aggregate. Yeah. Okay. So we don't know the breakdown of those. So it would, I mean, that's obviously important if the breakdown is that it's a lot of, some industry that's big right now. Mm-hmm. But if it's mixed across them, like a lot of utilities or something, then it would be attractive. Based on the numbers, the price is maybe a little high unless we know about the business, but it's the kind of thing that everything about it looks like it could have good economics. And so looking at it from a business perspective, it's a business I would want to learn a lot more about. From the numbers here, we cannot tell if it's cheap, but I also can't tell if it's expensive. Mm-hmm. And I really don't know about the free cash flow conversion. That could be caused just by being a very fast growing company, which is totally fine. If you're growing really fast and profitably, I don't mind if you're not producing much free cash flow. So tends to be, the CAGR here or something is like 14%, 10%, 10 to 15% growth in things like revenue and EPS and assets. That's high for us. That's a real growthy company, which doesn't mean that we wouldn't buy it if the price is low enough, but this is probably more of a growth company than we would normally buy. But if I could learn about it and see that it's predictable and the industries that it serves are not like cyclically in some sort of a boom or something, then I'd be interested in it. This is a company I want to learn a lot
Now,
about.
why wouldn't you want to own a growth company? Explain your thoughts on that. A lot of people are like, well, growth. Kind of, and you just said that we don't, maybe this is one that we would buy, but you kind of put it in the light of we don't like growth companies. So can you explain that?
Yeah, so we don't like growth stocks for two reasons generally. One, they are expensive. So the handicapping aspect of it means that you have to be more right about a growth company than a value company.
Meaning the future growth. Yeah.
Mm-hmm. And then second is that growth companies tend to attract competition in the areas that they grow in. So it's not, I think people often just think that growth companies, their risk is that they're higher price than value. That's not the only issue. The issue is that growth companies tend to have returns on equity and things like that will actually go down, whereas value companies tend to have returns on equity and things that will go up. Because when we talk about entry and exit in an industry, if you're in an industry that people like, more companies will go into that. If you're in an industry that everyone hates, more companies will leave it. And so you generally want industries where a lot of people are leaving it. Mm-hmm. We've talked before or something. I've talked a little bit about it, but people ask like, why do I like the lime industry in the U.S. or cement or something? Frankly, I think that in 10, 20, 30 years, there'll be fewer plants.
We talking about like lemons and limes and stuff
lemons and limes. Yeah, but quarries. So I think
Lime rock.
Lime rock. I think that there'll be fewer of them. So I think if I ever see an industry where I think, oh, demand will be the same in 30 years and there'll be fewer people in the industry,
Consolidation.
that's when I want to be in. Same thing with like when Buffett started buying all the airlines and stuff. Well, once it stopped being that you constantly had new airlines entering and everything, it becomes more attractive. So that's the only concern, is that when there's an industry that looks hot, I know that interests people, but what I worry about is competition. My biggest fear always with any stock that we talk about is competition. I always think that most companies will be undone by competitive pressure, not that they'll be undone by anything else, poor execution, by secular trends in different industries and things. I really think that it will be too many other companies like you will try to do the same thing that you're doing. That's always the big risk in capitalism. So that's always the thing I'm worried about.
Got it. Alrighty, next company, Equitable Group Inc., ticker EQGPF. Equitable Group. Looks like this is a bank, $1.4 billion market cap, trades over the counter, trading at a PE of about 11. Let's see. So net interest income, 17% CAGR over the past 10 years. Gross loans has grown about 71% over the past 10 years. Earning assets, 36%. Deposits, 13%. Revenue, or I guess you could say net interest income, has gone from $69 million in 2009 to $259 million in 2018. And EPS growth has also been quite well. The 10-year return on equity number is at 16%. So this is a bank. Have you ever come across this company before?
So a couple of things. One, I have not come across this company, don't know it. I'm going to take a wild prediction here and say this is not really a bank. It may say it's a bank, but I'm looking at some numbers here which make me think not a bank. So I don't think that a bank in the U.S. is levered 20 to 1. I don't think that its loan to deposits rate is well over 100%. It could be. Its return on assets is low. It looks something more like leasing or some sort of thing that is just, it says it's a bank.
Provides various financial services to retail and commercial customers in Canada. The company accepts term deposits and guaranteed investment certificates, high interest savings amounts, tax-free savings accounts, and institutional deposit notes. Its loan products include residential mortgages, home equity and cash surrender value lines of credit, mortgages on commercial properties and comprising mixed use, multi-residential properties, retail spaces, office condominiums, et cetera, et cetera.
No. This was a no. Some people might own this stock. I'm sorry if I said that. There were several words in there I didn't like.
Like what?
It's
high yield loans or
it's
what? Canada,
which is not where I want to be buying a bank, first of all.
We love you, Canada. Don't hate us.
Not where I want to be buying a bank right now. And secondly, it seems like it has high cost deposits, and I don't know that, but a high cost source of funding. And we've talked, like we did a whole podcast about banks.
Yeah.
And my big thing is having a very, very low all-in cost of funding. That's also my thing for insurers too. I really am worried about anything that has a high cost of funding. I think that you can do fairly you can do a few dumb things, and you can be not particularly smart or aggressive on the lending side, the asset side of what you do, as long as you have very, very low cost, stable funding. And so the only financial institutions I want to be involved with have low cost and stable funding, and then they can buy just about any asset and they'll do okay in it. I don't want to be in something that has to be that's making its money on the asset side while having fairly expensive way of funding itself. So we didn't look into the stock. It could be misrepresented on QuickFS and in that business description, but if you wanted in 30 seconds to explain a financial institution to me that I would say pass on, that was it.
You ever been to Canada?
I've never been to Canada.
Yeah, well, good. You're not allowed there anymore. Okay. Last ticker for the day, Game Host Inc., ticker GHIFF, market cap.
Where's this one located?
$149 million.
It's a Canadian stock.
It is a Canadian stock. PE, 13 times earnings. EV to sales, 2.9. They have a 10-year median margin on EBIT of about 37%. 10-year CAGR on revenue, 1.9%, going from $46 million in 2009 to $52 million in 2018. 10-year median returns for return on equity, 15%. 10-year CAGR on free cash flow, about 5.5%. It's currently trading about 10 times EV to free cash flow. Business looks somewhat predictable. I mean, gross margins look very predictable. But yeah, thoughts?
Well, I know what this company does. So
you cheated.
I cheated. Yeah. So this is casinos in Alberta.
Yep.
Yeah. So what we didn't explain there is that the revenue had gone up by about 1.5 times in about 5 years, and then it had come back down, dropping about 35% or whatever it is that brings it back to flat for about a 10-year period. And that's because of the boom, presumably, that happened in Alberta. And we talked a little bit about this. Not on this podcast. Andrew and I talked about it.
We both cheated.
Basically, there was a boom for things like oil. Basically, I mean, there was a boom in oil, but for everything connected to that. And I know some companies that have talked about what kind of boom that they saw there for labor and for wages and things like that. And some of those people could be customers that would spend a lot of money at these places. Yeah. So, I mean, presumably, I think to be honest, I think they were young men from other parts of Canada and other places who went there and who made a lot of money briefly, just like happens in certain parts of Texas and stuff occasionally, or in certain parts of the U.S. And that would really help your gambling business for a while, and then it would come down, and that seems to have been what happened. The returns look really good in the years in which we know there wasn't a boom in Alberta. So if we look at like 2015 to today, certainly, right after like 2013, 2014, I don't know the exact point at which it bottomed out there, and it also depends on when their financial reporting period is, but it still looks like pretty good. This is always a regulatory thing. So I would have to know that they're not going to open other casinos around them and things like that.
And we talked about that when we looked at Bucks. Butler International?
Butler National, yeah.
Yeah, Butler National.
Which operates the Boot Hill Casino.
Yeah.
Yeah. And so that's the Kansas lottery or whatever.
Yeah,
it decides on that, and they segment the state into, I think, 4 quadrants and then decide on like how much gambling there should be in each place. Same as here with this one, it's realistically, this is not... again, I'm going to get in trouble with Canadians here. Realistically, these are not destinations. People are not going to go to these places in Alberta to gamble.
Well, if they're able to
from the local area,
but that's probably good,
hours
isn't it?
away. No, that's good. I like that. I'm saying that it's not Las Vegas.
I was going to say, I would like that, probably.
Yes.
If you're thinking about like the predictability.
No,
of the
I like that
business
better as a casino. That's not Las Vegas. But I'm just telling people this is Macau
Argue
or
with me a
Las
little
Vegas.
bit.
Okay. This is not Macau or Las Vegas here that we're talking about. We're talking about things more similar, not as extreme, I think, but more similar to the Boot Hill Casino, to being in some place in rural Kansas. This isn't quite that extreme because I think we've seen a map where some of the casinos are in bigger places. Mm-hmm. But still, Alberta is not... it's not sort of the big metro center of Canada.
Yeah.
It's not. Yeah, that's not the side of Canada that's not the New York of Canada.
So if you want to look at promotional management, we've talked about this before on the podcast, but like an actual example of it, I read their investor presentation, I think from 2013 and then 2018. And when I read it in the 2013 one, I was like, holy cow, this is the most promotional investor presentation I have ever read of a company. Mm-hmm. A public company. And then I was like, okay, well, actually, this is 2013. Let's see what it looks like now.
Yeah.
And then I read 2018. I'm like, it's pretty much the same thing.
Yeah.
So if you ever want to see what we think a promotional presentation looks like from management to the point of probably getting scared away, go look up this company, Game Host. Maybe that'll be a good exercise for a lot of people.
Yeah, and I wasn't scared, and I should say I wasn't scared away by that. That makes it harder always if management is more trying to pitch you on the idea of a stock. And
it came across much more of a pitch. I mean, when a slide says
like an ad,
why you should own, why Game Host Inc. should be in your portfolio. I mean,
I mean, that's what investor relations job is. But
absolutely, marketing and stuff like that.
Yes, and to some extent, again, not to offend Canadians, to some extent, the United States compared to some other countries, it sometimes has a little extra conservatism in certain representations made to investors that I think compared to some other things. So, like if you read especially if you read the US 10K, there's some stuff in there that's like, why not to invest in us? And they can go a little overboard with that. I've read more in other countries that are more like what this investor presentation was like. But I still think the business is interesting, the asset is interesting, and so it's definitely something that I would look at. But I'm at a huge disadvantage as an American. People in that part of Canada and people who understand politics and things in Canada would have a better idea of regulatory stuff, of the risks of whether they ever would put casinos near them and stuff. And they talked about things that have been denied permission for a casino. Gambling is a terrific business if you can keep other people out of it nearby you. Yeah. But if there's too many casinos around, then it goes away. Sure. And these are always based on their EV to EBITDA and stuff that they have now. It doesn't look expensive, obviously, at all for a casino. And if it will recover at some point, if that economy, local economy, will do even better, then it looks really cheap. So, I mean, just looking at the numbers, to be honest, for a casino, and for a casino that might be in a region that is economically not at a top right now, looks cheaper than most. So, I mean, if you were looking for a casino, I guess you should look at the stock.
So what, out of all the 5 that we looked at today, which one would you be most interested to learn more about?
Let's go over the 5 again. What 5?
Okay, so we got Miller Industries, Matson, Badger Daylighting, Equitable Group, which you said no way, and Game Host.
Game Host and Badger Daylighting.
There you go. Alrighty, I want to thank everybody. Both?
Not a recommendation on either one.
Let's say both Canadian companies.
Yeah, after I said all that, not a recommendation on either one. The business.
Yeah.
The business of
Learn
both of them
about
interests me. I don't know about the management of the organization. The business of both interests me.
Learn more about it. Got it. Well, thank everybody so much for tuning in with Mr. Geoff and myself. If you're watching on YouTube, hit that subscribe button, thumbs this video up, leave us a rating review on the podcast side of things. Canadians, I promise we love you. We'll see you in the next podcast. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.